Welcome to the Deep Dive. We're the show that helps you navigate through, well, the often complex world of financial reports.
Yeah, trying to find those insights that really matter.
Exactly. We know sifting through balance sheets, earnings calls, it can feel like a bit much.
Definitely daunting sometimes.
So our mission here is to cut through all that noise and deliver the crucial bits you need to be properly informed.
And that's precisely what we're diving into today. We're looking at Indian Bank's unaudited financial results.
Right. For the first quarter of fiscal year 2025-26. That's the period ending June 30th, 2025.
And our goal isn't just throwing numbers at you. It's about helping you understand what they really mean, for the bank's direction and maybe even the wider economy.
Definitely. And to really get the full picture for this deep dive, we've looked at a whole stack of sources.
Everything, really.
Yeah, the official board meeting stuff, the detailed financials, management's own presentations.
And even the Q&A from the post-earnings conference call, which can be quite revealing.
Absolutely. So let's get into it. Let's peel back the layers and see what these results tell us.
Okay, starting with the big picture view. Indian Bank put up some pretty impressive numbers in Q1. Their net profit saw a really significant jump. We're talking 23.69% year-on-year,
Wow.
reaching 2,973 crore.
Okay, and just for context, a crore is 10 million rupees, so that's nearly 30 billion rupees? Big number.
It is. And what's interesting is, even compared to the previous quarter, so quarter on quarter, there was still a slight growth by 8.57%.
That's a strong start, no Colden. Now, you mentioned operating profit. I did notice it was up nearly 6% compared to last year at 4,770 crore.
Right.
But there was a small dip compared to the quarter just before it. What was sort of the main reason there? Is it something to worry about or more of a one-off thing?
That's a great question, and it actually leads us nicely into the details. But before we get right into that, let's just touch on the bank's overall size.
Okay.
Their total business crossed 13.45 lakh crore.
Rock crore. That's 100 billion, so over 13.45 trillion rupees. Huge scale.
Exactly. And that reflects solid growth, 10.25% year-on-year. And this positive direction is backed up by some healthy key ratios, too. Return on assets, ROA, that was 1.34%.
Which is up 14 basis points year on year, and a basis point is just 1/100%.
Correct. And return on equity, ROE, hit 20.26%. That climbed 50 basis points, so 0.5% year-on-year.
Pretty good.
Yeah, and our earnings per share, the EPS, also grew nicely, up 23.69% to 88.28.
So here's maybe the aha moment for you listening. This isn't just about growth numbers. It's a really powerful signal that Indian Bank might be fundamentally shifting its core operations.
How so?
Well, getting a 20% return on equity in today's market, that's not just impressive. It kind of suggests a real strategic move towards capital efficiency. And that could really underpin, sustained value creation for the longer term.
That's a great point. Okay, so moving into the more granular stuff, the financial performance details. Net interest income, NII, that's their core income from lending.
Right.
It stood at 6,359 crore, showed a 2.93% increase year-on-year.
And the interest earned, that was 16,283 crore from loans and investments.
Yeah, and that figure, it's not just big, it reflects how they're successfully using their loan book.
Right.
Seems like they're finding profitable ways to deploy capital, even with, changing interest rates.
Okay, so back to that operating profit dip question. Non-interest income, that's fees, commissions, things like that. It did drop 11.0% compared to the previous quarter, coming in at 2,439 crore.
Right, but the management was quite upfront about this.
Yeah.
They explained it was largely because, well, two things were missing this quarter. They were there last quarter. A euro income tax refund and about 86 crore from penal charges, which they apparently only recover half yearly anyway.
So not really a drop in their core fee business, more just timing and one-offs.
Exactly. So it wasn't a systemic decline, just an expected fluctuation based on those items.
Got it.
And actually, despite that QOQ dip, the non-interest income still showed really strong year-on-year growth, up almost 28%.
That's quite significant.
Yeah. Now, on the expense side, interest paid out was 9,924 crore, and the cost of deposits, that did nudge up slightly, from 5.1% to 5.14%.
Okay, only a small increase, but still important, right? Because that's the cost for the funds they lend out.
Absolutely. Managing that cost tightly is crucial for their margins.
Then operating expenses
Came in at 4,028 crore. Both employee costs and other operating expenses were pretty much flat compared to the last quarter.
Okay, but the cost-to-income ratio did tick up a bit to 45.78%.
It did, but again, that was directly linked to that temporary dip in non-interest income we just talked about.
Yeah.
It wasn't because the bank's actual core costs went up. So that helps understand the real picture there.
Okay, that makes sense. What about margins? Net interest margin, NIM.
All right, NM. For domestic operations, there was a 13 basis point decline quarter on quarter, down to 3.35%.
A slight squeeze there.
A little, yes. However, management's outlook seems, well, reasonably confident. They expect maybe only a further marginal decline next quarter.
Okay.
And they actually anticipate it stabilizing or maybe even improving after that.
Why's that?
Because significant chunks of their deposits are due to reprice soon. We're talking about 33,000 crore in bulk deposits this quarter and around 86,000 crore in retail term deposits over the next 3 to 6 months. As those reprice, it should help the margin.
I see. And they kept their full-year guidance.
They did. Reassured everyone they're sticking to the 3.15% to 3.38% range for the full year NM.
Okay, so for you listening, this breakdown, it helps you see how all these different income streams and cost controls, how they actually combine to generate profit for the bank.
Yeah. And those NM fluctuations, they're important signals that tell you something about the wider banking environment and how the bank's adapting its strategy to keep those margins healthy.
Right. Now, let's shift gears a bit. Let's do the health check. Asset quality, risk management, always crucial for a bank.
Absolutely critical. And here, Indian Bank has shown some really impressive improvement.
Okay.
Gross non-performing assets, GNPA, basically bad loans, saw a significant drop, down 76 basis points year on year to 3.01%.
That's a good move.
Yeah.
Down, and even quarter on quarter.
Down 8 basis points quarter on quarter, too.
And the net NPAs, after provision.
Even better. NPA fell 21 basis points year on year to just 0.18%.
Wow, 0.18%. That's remarkably low.
It really is. And down 1 basis point quarter on quarter as well.
So what does that low NNTA figure tell us specifically about their, say, credit underwriting standards compared to the industry? Does it really boost their resilience?
Oh, absolutely. It tells us they're keeping very tight control over the lending book, which is excellent. It suggests strong underwriting and effective recovery processes. And this is backed up by strong provision coverage ratio, PCR, including technical write-offs that improved by 154 basis points year on year.
To what level?
An impressive 98.20%.
Yeah.
Essentially means they've set aside funds covering almost all of their identified bad loans.
Very strong coverage.
Yeah. And their slippage ratio, that's new loans turning bad, was kept well under control at 0.94%. That's down from 1.50% a year ago.
Good improvement.
And credit costs also improved substantially, down to 0.28% from 0.71% year on year.
Yeah.
They expect it to settle between 50 and 70 basis points for the full year.
Okay, now let's unpack this next part, because at first glance, it looked like maybe a small red flag. Special mention accounts, SMA.
Right. Loans showing early stress signs.
Yeah. There was a temporary increase quarter on quarter in SMA2, the slightly more stressed category, apparently due to 2 specific PSU accounts, public sector undertakings.
That's correct. These 2 PSU accounts totaled around 3,300 crore, which caused that temporary bump in the SMA2 figure.
Okay, so what's the clarification?
Well, the crucial point from management is that those accounts have already moved out of SMA2 since the quarter ended, which brings the current SMA2 figure right down to just 815 crore. And, importantly, they're not expected to slip into NPA, into becoming actual bad loans.
Why not?
Because there are government guarantees available for them.
I see. So that proactive management and the government backstop, it really changes the perspective on that temporary increase.
Completely. It flips what looked like a potential concern right on its head. Shows the underlying support is strong.
Okay, that's much clearer. And beyond that specific issue, what about overall capital strength?
Very robust. The capital adequacy ratio under Basel III rules stands at 17.80%.
That's well above regulatory requirements.
Definitely. And the core capital, CET1, is at 15.26%. So a very strong capital position overall.
Any other positive signs on risk?
Yeah. They also mentioned an increase in their AAA-rated exposures, which is top quality, and a slight reduction in risk-weighted assets density. Both good signs of prudent risk management.
Okay.
And one more point on risk management. They've strategically reduced their exposure to non-banking financial companies, NBFCs.
Oh, yeah. By how much? Down from 62,000 crore to 56,000 crore. So actively de-risking that part of the portfolio a bit.
Right. So boiling it down for you, the listener, if you're a customer or maybe thinking of investing, these technical ratios, they translate into real benefits. They indicate the bank's stability, its ability to handle economic bumps, and its solid capacity to keep lending responsibly.
Exactly. Okay, so moving on to what's actually fueling the bank's growth, let's talk loans and deposits.
Right. The engine room.
Pretty much. Gross advances, overall loans, saw 11.50% year-on-year growth, reached 6.01 lakh crore.
And quarter on quarter.
Healthy growth there too, 2.21%.
Yeah, here's where their strategy really seems to come into focus, right? The RAM segment.
Yes, the RAM focus retail, agriculture, and MSME. That's clearly a priority.
And the growth there was strong.
Very strong, up 15.93% year-on-year, reaching 3.63 lakh crore.
So for you listening, that strong RAM growth is generally seen as a positive sign. Why is that?
Well, these loan categories, retail, farming, small businesses, they're usually more diversified, more granular, meaning less risk concentrated in a few big loans.
Exactly. They're typically less susceptible to large-scale defaults, which adds a lot to a bank's stability. And RAM now makes up over 65% of their domestic loans.
And within RAM, any specific standouts?
Yeah, good growth across the board. Retail loans up 16.56%, agriculture up 16.40%, and MSME up 14.45% year-on-year.
Home loans doing well.
Particularly strong, yes.
Yeah.
Home loans were up 10.65% year-on-year.
What about the big corporate loans?
Corporate credit saw a marginal dip quarter-on-quarter, about -1.41%. But still positive growth compared to last year, up 1.77%.
Okay. And they're meeting their priority sector lending targets, lending to specific crucial sectors.
Exceeding them, actually.
Yeah.
They achieved 44.73% of adjusted net bank credit against the mandatory 40% target set by the RBI.
So hitting their social and economic objectives there too.
Seems so. Now, flipping to the other side of the balance sheet, deposits.
Where they get the money to lend?
Exactly. Total deposits increased by 9.26% year-on-year, reaching 7.44 lakh crore.
Solid growth. What about CASA, the low-cost current account and savings account deposits?
Ah, CASA. The domestic CASA ratio stood at 38.97%.
Slightly below their target, I think.
Yes, and management was quite candid about this. They acknowledged that keeping it at the 40% target is proving challenging right now.
Any reasons given?
Yeah, a couple of factors. Things like the just-in-time JIT payment systems used for government accounts, which reduces float.
Okay.
And also customers shifting some funds to alternative investments, probably seeking higher returns than basic savings accounts offer.
Right. That's a common challenge for banks now, but are they doing anything about it?
They are. They're not just sitting back. They've actually just launched 5 new CASA products.
Oh, interesting. Targeted.
They're very targeted. Specific products designed for MSMEs, for women, for pensioners, professionals, and even specific salary accounts, trying to attract and hold on to those low-cost funds.
A focused approach then. And their CD ratio, credit deposit ratio,
stood at 80.77%.
So basically, for every 100 rupees in deposits, they've lent out about 81 rupees.
Pretty much. It shows they're efficiently using their deposit base to fund loans, which is generally seen as a healthy sign of effective capital use.
Okay. So for you, the listener, understanding these dynamics is pretty key. That RAM growth points to stability. Deposit growth fuels the lending engine. And that focus on CASA, well, it matters because those are cheaper funds for the bank, boosting profitability and competitiveness.
Well put. Now let's talk about technology and reach. How Indian Bank is using digital tools and expanding its network.
Yeah, the digital push seems quite aggressive.
It really does. Get this. In Q1 alone, nearly 58,000 crore of business was generated through their digital channels.
58,000 crore.
Yep. That's a 58% growth compared to the same quarter last year.
Huge jump. And user numbers.
Also climbing steadily. Mobile banking users up 15% year-on-year to over 2 crore. UPI users surged 23% to almost 2.3 crore. And net banking users increased 6% to over 1.1 crore.
And they're adding new features, too.
Constantly, it seems. They mentioned launching 132 digital journeys, utilities, and processes. It really shows a comprehensive effort to simplify banking for customers digitally.
Any specific new digital products worth highlighting?
Yeah, a few interesting ones. There's a lighter version of their main mobile app, InSmart, specifically just for UPI transactions, probably faster, easier for quick payments.
Makes sense.
A new app for MSME businesses, designed for end-to-end loan applications, streamlining that process.
That could be very useful for small businesses.
Definitely. And they've even rolled out a digital keys-on credit card, KCC, journey. But that's currently in states where land records are already digitized.
Smart. Using existing digital infrastructure to help farmers.
Exactly. And technology isn't just for transactions. They're using it for customer experience and even collections.
Oh, yeah. How so?
They've introduced something called agentic AI for collections.
Agentic AI, what does that mean exactly?
It sounds like AI that can act more autonomously. So maybe not just a simple chatbot, but AI that can proactively manage communications with customers about overdue payments, perhaps. It's currently in English and Tamil.
Interesting. Streamlining a tricky process.
Potentially, yes. They also have an employee assist chatbot internally. Help staff quickly find answers to guidelines so they can respond to customers faster.
Improving internal efficiency, too.
Right. And plans for a next-gen call center and automating parts of corporate credit assessment are also in the works.
Okay, so a big digital focus. But are they neglecting the physical side, branches?
Actually, no. It's quite interesting. They're also expanding their physical footprint.
Really? In this digital age?
Yep. The bank plans to open 119 new branches this year because it's their 119th year, a nice touch.
Huh, okay.
And 51 of those were already opened in Q1.
Is there a specific strategy behind where they're opening these new branches?
Yes, seems very strategic. They're targeting high-potential regions like Mumbai, Gujarat, Rajasthan areas where the bank's current market share is lower, despite these places contributing significantly to India's GDP.
Ah, so filling geographic gaps to capture new growth.
Looks like it. A blend of high-tech and high-touch.
And supporting all this, presumably, requires people.
Absolutely. They plan to hire 3,000 new employees this year, a mix of specialized roles and generalist banking officers. And they're also doing a complete revamp of their training system, making it more interactive, more effective, crucial for keeping the workforce skilled up in this changing environment.
So for you listening, what does all this mean? Well, these initiatives, digital and physical, they aim to make banking with Indian Bank more convenient, more efficient, and more accessible.
Yeah, whether it's a slick new app feature or a helpful person in a new local branch, they seem focused on meeting customer needs and adapting for the future.
Okay, finally, let's look just beyond the immediate quarterly numbers. What about the bank's broader commitments? ESG.
Right. Environmental, social, and governance. It's increasingly important, and Indian Bank seems quite dedicated here.
How so? On the environmental front?
Well, they have a significant exposure to green finance, over 9,400 crore, plus various initiatives in their own operations.
Like what?
Things like installing lighting sensors, using LED lights, rainwater harvesting systems, putting up solar panels, even replacing over 1,300 old diesel generators to cut emissions. Practical steps.
Okay. And the S, social.
Robust efforts there, too.
Yeah.
They support rural development, trained over 8,000 candidates through their rural self-employment training institutes. Big focus on women's empowerment, too. They finance 59 lakh women through self-help groups. And internally, they maintain a 30% gender diversity rate among employees, plus strong corporate governance policies, the G.
So for you, this ESG commitment, it signals they're a forward-thinking institution, right? Thinking about their wider impact, not just the profit line.
Exactly. And that's increasingly important for long-term sustainability and just, well, reputation.
Has this focus earned them any recognition, awards?
It has, actually. Quite a few. Recently, they got overall data quality recognition at something called EASE 7.0.
Okay.
Third place in the Digital Payments Awards, a special mention for merchant onboarding in difficult geographies. They also won a prestigious SCOCO Seach Award for Project Wave.
What's Project Wave?
That's their big digital transformation journey we talked about. And also for an SMA collection proclivity predictor using analytics for collections.
Ah, tying into that agentic AI, perhaps?
Could be related. And also Best Public Sector Bank and CEO of the Year at the Tamil Nadu Leadership Awards 2024. So, yeah, get noticed.
Okay, so let's try and wrap this up. To recap our deep dive into Indian Bank's Q1 results, we've seen a period of, well, pretty strong financial performance overall.
Definitely. Marked by that impressive net profit growth.
And really significant improvements in asset quality. That NNPA figure is striking.
It is, and their strategic focus on that RAM segment, plus the aggressive digital push, seems to be clearly yielding results.
And underpinning it all, that commitment to ESG principles, reinforcing their role as a, responsible and recognized player in the sector.
Absolutely. The bank is certainly setting a confident pace for the year.
So that leads us to our final thought for you to ponder. As Indian Bank pushes ahead with these ambitious plans, digital transformation and branch expansion, how might this blend, this mix of high-tech and high-touch banking actually redefine the customer experience and maybe even shake up the competitive landscape in India's banking sector over the next year or so?
It's a compelling question, isn't it? Thinking about how banking is evolving, how innovation and physical presence can combine to reshape things.
Definitely something to reflect on. Maybe even look at your own banking relationships through that lens.
Good thought.
Thanks for joining us for this deep dive. Until next time, stay curious.